Hey everybody, it's Pete. Welcome to Stock Trading Pro. In today's trading education, I'm going to take you behind the scenes again into last night's coaching call. We're going to discuss two very important topics. I think two that are really important, especially in today's stock market conditions, which are understanding tape reading using level 2 and time and sales. And we're going to talk about hedging. And we actually give an example just from this week in the current stock market conditions, using a stock as a buying opportunity and a different stock as a sell short opportunity to hold the gains on the winning trade, the stock that you bought, while the stock market went down last week and actually got crushed on Thursday and Friday. So you actually made money on the short sale while you protected the long gain on the stock that you bought. These are two really interesting topics, very actionable, actually. So if you find this stuff valuable, awesome. Definitely subscribe and make sure you hit the like button if this is the kind of stuff that you really enjoy. Thank you so much. I really appreciate it. But that's a well-worded question given the market conditions. Let's see. Hey, Walter, how's it going? Like some clarity on tape reading, taking the tick and the charts out of the equation. Okay, so that we talked about this quite a bit this at the start of today's call, which is level 2 trading and reading time and sales. When there's a bid price of 5,000 and an ask price of 15,000, 5 cents above that is the resistance at the ask price. Again, depends on how liquid the stock is, depends on how many how active is time and sales trading. Something else that's not taken into consideration, but let's just answer this on the surface of this question. In this instance, yes, but what kind of liquidity is behind this? Is this the only offer? Is there a lot more offers at 56, 57, 58? Or is there nothing behind 56, 57, and 58? So I'll give you an example. And again, I don't want to go too much into the weeds on reading time and sales because it's a completely different animal. Let's say, for argument's sake, 2555 has 15,000 shares on the ask, and that looks like great resistance, right? Which most of the time it probably is, right? But let's say at 2556, there's 1,100 shares. And then, and then 25, not 50, 45, 56, and then 20. So we're looking at level 2 right now. So we're looking at quotes that go up. So these are now the offers. That's the lowest offer right there. And now we're looking at, let's say, 900. So yeah, that's a big resistance level, but you have to look at level 2 and say how much is beyond that. Because that might look like a wall of heavy resistance of it's got to get through all those shares. And that would be correct. But if you look beyond that and there's nothing at the next levels and it doesn't really, the next 15,000 shares on the ask is 2570, for example. All of a sudden that resistance is solid, but if it breaks through that resistance, you're looking at 15 cents to the next level, which in that time period can be significant, especially if you have size and you're leaning on that as support. So technically the answer is yes, but you need to look through it more to see what other bids and offers are supporting it. What do we want the price to blow through the ask to show bullish price action? Yeah. And Walter, I don't know if you're in the community as much during the day. Listen to Fred Grove or watch Fred Grove talking. He spends a lot of time talking about the lower price stocks he's watching, and he'll say there's a seller at X price. So let's use your example. There's a seller at 25.55. They're chewing away at him. If they get through him, this thing's going to go. So that's the kind of language that we're talking about. So he's probably also looking at the other levels like I just described. So if there's a big offer there and they're chewing away at it, and he says it's going to go, that means that the other levels don't have resistance past there. If all the other levels have a lot of share size, then yeah, that's probably a rock of Gibraltar and it's not going to get through there unless time and sales lights up like crazy and you start to see trades go through there. So in this case here, let's just say we're using 140.80 as an example. If all of these are green and 1,100, 2,000, 5,000, 10,000, and they're ripping through that, it's probably going to go through. It's probably going to go through. But if it doesn't, that means that somebody's got a gigantic offer and it's going to end up going down. If they keep pounding through there and it's not going through, that means somebody has a big offer. Somebody's got a lot to sell at that price. Obviously, a much different conversation than just looking at the charts, which is why level 2 and time and sales is a whole other practice. The bid ask are placed orders. Yep. I tend to say advertise. Like the bid is the best price you're advertising to buy. The ask is the best price you're advertising to sell. And tape reading is the actual transactions. So yep, you're 100% correct there. Absolutely. Let's see. I have a question in regards to hedging. Can you elaborate on how you hedge and how it usually turns out for you? Well, that's kind of a loaded question. It turns out the same way every other trade that I manage. Some of them work, some of them don't. I've never hedged. And when I think of hedging, I simply think of someone always breaking even. Well, if you think about the term hedge fund, that's literally why the name came into existence. They're managing the downside. So don't think about hedges as breaking even. Think about a hedge as protecting one side of your bias. So if you're looking to be a buyer of something, so let's just use some of these. Let me go we'll go here just as an example. Let's use IBM as an example. So let's say IBM is a stock you want to be a buyer of, and I'm not going to get into the mechanics of how many shares and how much dollar amount. Being a buyer of IBM is one side of the trade. Being a short seller of a weak stock is the other side of the trade. So you would buy IBM and short sell against that position in a weak stock. That's how professional traders hedge. You're trading one side of a bullish market against the bearish side of a bearish stock. Now, there's a whole bunch of other parts to that equation, which is, do you do the same dollar amount? So in other words, if you bought 50,000 shares of IBM, $50,000 worth of IBM, and you want a complete hedge, then you'd have $50,000 worth of the hedge on the short side. I'm not usually a big fan of it being dollar for dollar because I'm really just looking to protect the downside. So if the market and your stock that you bought goes down, in a perfect world, your hedge goes down. So you're protecting the stock you bought by making money on the stock you sold short as the hedge. And these are probably two good examples here. Okay. I simply think of someone always breaking even. No, it's not breaking even. It's in the context of trying to maintain the position that you like. If one trade goes down and the other goes up, is it usually how it works? That's best case scenario. That's why I said here how it usually turns out. Best case scenario, you're long. Let's say you're IBM long. Let's say, and again, this actually did happen last week. IBM really didn't sell off that hard. So let's say the market, you love this stock, you want to be a buyer, so you buy this stock, but then you short sell a weak stock. So when the market goes down, best case scenario, your weak stock goes down over that same time period, while your strong stock basically stays the same. Stays the same because it's strong, the whole reason you're in it in the first place. Worst case scenario, you have the hedge on, this stock goes down a little bit, but you're making money on the short sale hedge. Now, this is where timing comes into the equation. When do you get rid of the hedge? Well, if you believe the downside is done, bullish U-turn here, bullish U-turn in the market, you lift the hedge and you look for your long to play itself out. Obviously, that's something we need to discuss while it's happening and the whole thing. But an absolutely fantastic question to finish up today's call. Absolutely fantastic. Go back to that part that we just did. And just if you can think about the IBM long and the NVIDIA short, the market getting hammered for 2 days, IBM held up, NVIDIA went down. So you would have been making money on the short, maintaining your IBM long, and then you decide when you take the hedge off. When you take the hedge off, that's the really advanced stuff.